Let's unpack this. We've got quite a stack of sources here, articles, reports, your notes, all pointing to the global financial picture on one specific day, June 10th, 2025.
That's right. A snapshot in time.
Our mission in this deep dive is not just to, summarize. We want to cut through the noise, pull out the really vital nuggets of knowledge.
Find the connections.
Exactly. Understand how these seemingly disconnected events are actually linked, and most importantly, figure out what this all means for you.
And Juneteenth is actually a great day for that because it really does show that interconnectedness. You see policy moves in, say, Washington or London, and like within hours, you see ripples in corporate earnings calls or, central bank decisions halfway across the world. It's complex.
A web, yeah. These sources should help us trace those threads.
Definitely. It's a good set of materials.
All right, let's jump right in. The biggest piece of news from the day, it seems, came straight from the World Bank, their latest Global Economic Prospects report.
Yes, that dropped on the 10th. And the headline, well, it's undeniably a significant downgrade.
A downgrade, okay.
Yeah, they substantially cut their global economic growth forecast. For 2025, they're now projecting growth at just 2.3%.
2.3%, that's quite a drop from their January projection, right? Down 0.4 points.
Exactly. And it's also slower than the 2.8% growth we apparently saw in 2024.
Wow, 2.3 globally. The sources were saying that's really sluggish, like the slowest growth rate, unless we're talking an actual global recession.
That's the comparison they made, yeah. It's worryingly slow.
So why? Why such a big haircut to their forecast? What are the main drivers?
Well, the World Bank is pretty clear on this. They point directly to a significant increase in trade barriers. That's one key thing.
Okay, trade barriers.
And also intensifying trade tensions and policy uncertainty. They use some strong language, actually, highlighting what they call erratic and aggressive trade policies.
Like those 10% tariffs we saw mention.
Exactly. Those tariffs on imports from many countries are flagged as major factors dragging down the forecast.
So they're really putting a lot of the blame for this global slowdown squarely on, well, trade protectionism.
They really are.
Yeah.
And it's broad-based. The report, as it's stated in your sources, notes that forecasts were lowered for roughly 70% of economies.
70%. Across different regions, income groups.
Yeah. So it's not just one or two places. It's a pervasive headwind for the global economy right now.
Okay, let's break that down a bit. How did this affect the forecasts for some of the, the major players? What did the World Bank say?
Well, the impact was pretty dramatic in some cases. The U.S. forecast, for instance, got cut by 0.9 points.
Almost a full percentage point.
Yeah, down to just 1.4% growth. And the source links that directly to the impact of tariffs.
Okay. What about China?
China's expected to slow, too, from 5% in 2024 down to 4.5% in 2025. Again, tariffs cited, but also the domestic stuff like real estate issues, aging workforce.
Right, and the Eurozone.
Looking very weak. Just 0.7% growth. That's down 0.3 points. And again, influenced, the report says, by U.S. tariffs and just general policy. Unpredictability.
Even fast-growing places like India saw a dip.
A slight dip, yeah. Still forecast at 6.3%, which is strong, but lower than before. Japan, Mexico, also impacted.
Mexico seemed to get hit particularly hard.
It really did. The forecast there was slashed by 1.3 points, bringing it down to just 0.2% growth.
0.2, wow.
Given Mexico's heavy reliance on U.S. trade, that cut really highlights the vulnerability when that relationship gets tense.
That really stands out. And here's a detail in the sources I found fascinating. The World Bank estimated that if these trade disputes were resolved and tariffs were halved, it could actually add 0.2 points to global growth in both 2025 and 2026.
Exactly. Think about what that means. 0.2% of global GDP. That's a lot of potential wealth, jobs, opportunity, just lost to friction.
It really quantifies the cost, doesn't it?
It does. It suggests the economic costs of these trade wars might be really outweighing any perceived benefits. Maybe implies that chance for a soft landing.
Where things slow down gently.
Right. That opportunity might have been missed specifically because of these policies.
So the picture is slower global growth, hit hard by trade barriers, plus persistent inflation. The forecast was still around 2.9% for 2025, right? Above pre-pandemic levels.
Correct. And inflation also influenced by tariffs, making imports pricier, plus tight labor markets.
Which sounds like that tricky situation, mild stagflation.
Precisely, that combination. Slowing growth, but inflation still sticking around. It's a tough environment.
Why tough?
Because the usual tools fight one, but can worsen the other. Lower rates to boost growth might fuel inflation. raise rates to fight inflation might stifle growth even more.
Okay, so what does that kind of environment mean for you, our listener?
Well, it creates challenges. As a consumer, tariffs and inflation mean things, especially imports, stay expensive.
Sure.
Your purchasing power gets eroded. If you're an investor, a business owner, slower global growth means fewer opportunities while inflation hits your costs.
And developing economies.
They're particularly vulnerable, less financial cushion, it hits job creation, poverty reduction efforts. The World Bank analysis really hammers home how linked trade, inflation, and growth are.
And they imply a need for, what was it, a rapid course correction?
Yes, and renewed global dialogue and cooperation on trade. That was the underlying message.
Speaking of dialogue and trade tensions, the sources highlighted these high-stakes U.S.-China talks happening in London on Juneteenth.
Right, those were critical discussions, reportedly went late into the second day.
What was the main focus there?
Trying to resolve specific disagreements, particularly over export controls, and aiming for a longer-lasting truce in the bigger tariff war.
What kind of specific issues were on the table?
The key one was China's export of rare earth minerals and magnets. These aren't, minor things. They're vital for EVs, green tech.
Critical inputs.
Absolutely. And China had apparently suspended these exports before, causing problems. The U.S. side hinted, maybe, at easing its own controls, like on semiconductors.
If China sped up the rare earth deliveries.
That seemed to be the trade-off being discussed.
It raises a question, though. Why have these specific materials, these tech controls, become such big levers? It feels different from just tariffs on finished goods.
That's a really important point. It shows how raw materials and tech exports are now seen as strategic assets. Geopolitical tools, really, reshaping supply chains way beyond just tariffs.
Okay, so these critical talks are happening. How are the markets reacting back home?
Well, U.S. stock markets were actually kind of hovering just below all-time highs that day.
Waiting.
Definitely seemed like a holding pattern, waiting for news from London, which itself shows how much weight these talks carried for investor confidence.
And the recent rally? That was partly fueled by hopes of a deal, right?
Very much so. The sources said stocks had recovered from that 20% drop a couple of months prior, largely on hopes President Trump would cut tariffs if he got trade deals.
So optimism was really pinned on a positive outcome there.
Exactly. The S&P, Dow, NASDAQ saw small gains that day. But the sources also noted global markets stayed jittery, and a lack of positive headlines actually started weighing on stocks and the dollar later in the day. It was a fragile optimism.
And this is where we see that direct hit on specific companies, despite the market hope. The sources gave examples.
They did, and it's a fascinating contrast. While the broad market is hopeful, companies operating now are facing the uncertainty. Take designer brands DSW Shoes.
Yeah.
On June 10th, they actually pulled their entire financial forecast for 2025. Just withdrew it.
Hold the whole forecast. Why?
They explicitly cited uncertainty stemming primarily from global trade policies and ongoing instability and pressure on consumer spending. Their stock plummeted over 20%.
Wow. That's a direct hit. Any others?
Yeah, J.M. Smucker. Their stock fell over 15%. They actually beat earnings, but their revenue and, crucially, their future profit forecasts missed expectations. Again, pointing to a tough environment.
But not all bad news.
No, not all bad. Innovation still counts. Tesla was up 5.1%. TSMC's U.S. shares gained on strong revenue. And Casey's General Stores jumped, apparently driven by sandwich sales.
So you've got the market generally hopeful, but specific companies saying, we can't plan because of trade policy uncertainty. What's that tell us?
It highlights that disconnect, right?
Yeah.
Between speculative hope and the real operational challenges. When companies can't forecast costs, supply chains, demand, because policy is unpredictable, it just paralyzes planning, investment.
Designer brands being a prime example.
A perfect illustration. It really shows how policy uncertainty hits the ground. It underscores that maybe that soft landing isn't guaranteed, and the pain from trade policy is real and uneven.
Okay, let's shift from trade policy to fiscal policy. Taxes and spending. The U.S. House was working on a proposed mega tax bill on Juneteenth.
Yes, a very significant piece of potential legislation. Framed as a broad tax and spending compromise bill. Yeah. Still needed Senate approval, of course.
What were the key parts of this proposed package?
Well, it was wide-ranging. Big elements included making the 2017 individual income tax cuts permanent. That's a huge fiscal commitment.
Right.
Also proposed temporarily increasing the standard deduction, making auto loan interest deductible for a time. On the business side, boosting the child tax credit, permanent hikes to estate gift tax exemptions.
What about business investment?
immediate expensing for R&D costs, and 100% expensing for certain structures, like in manufacturing. But also, notably, it proposed ending major clean electricity tax credits from the IRA.
Ending the IRA credits. Okay, shifting priorities there. That sounds like a lot of tax cuts. Was there spending involved?
Yes, spending cuts were proposed to partially offset the revenue loss. The tax cuts were estimated around, what, $3.75 trillion over 10 years?
Yeah, something like that.
The bill aimed to claw back about $1.3 trillion through spending reductions, mainly targeting programs like Medicaid and SNAP, the Food Assistance Program.
Okay, big tax cuts, partially offset by big spending cuts. What were the predicted overall impacts the analyses cited?
Right. Different groups had different takes. The CBO Congressional Budget Office estimated it would still increase the deficit by about $2.4 trillion over a decade.
$2.4 trillion added to the deficit?
Yes. And they also projected it would lead to about 10.9 million more people being uninsured, mostly due to the Medicaid changes and new work requirements mentioned.
Okay, and other analyses, like the tax foundation.
Their preliminary look suggested the tax parts could boost GDP by 0.8% long-term, create nearly 1 million jobs, but they also saw a big deficit increase, about $2.6 trillion over 10 years conventionally.
So potential growth in jobs, but definitely adds trillions to the debt. A classic debate. But there was one part you mentioned was really controversial, Section 899.
Yes, Section 899, the unfair foreign taxes provision. This is where things got really heated, and it links right back to that global friction theme.
So.
This section basically proposed giving the U.S. government power to slap taxes on foreign companies and investors if their home country was deemed to impose unfair taxes on U.S. companies operating there.
Sort of a tit for tat on corporate taxes. What were the concerns?
Major concerns from critics, especially groups representing international firms investing in the U.S., they argued it could seriously deter foreign investment.
How?
They warned it could hit these foreign companies' U.S. profits with an extra tax rate up to 30%. The Global Business Alliance estimated this section alone could cost the U.S. economy hundreds of thousands of jobs.
360,000 jobs.
Yep.
And $55 billion a year in lost GDP.
That was their estimate, yes. Over a decade. They even suggested it could wipe out maybe a third of the bill's expected overall economic growth benefit.
Wow. So this raises a question. How can one section, supposedly aimed at protecting U.S. interests abroad, potentially boomerang and hurt the U.S. economy like that?
Right. It seems counterintuitive.
Yeah.
But it highlights that core tension we keep seeing, trying to protect domestic interests versus needing foreign capital and stable global economic ties.
So the fear was it makes the U.S. less attractive for investment.
Exactly. Critics argued it ultimately harms U.S. businesses, consumers, workers. Some even worried it could extend the damage of the failed tariff war by maybe provoking retaliatory tax measures from other countries.
So protectionist fiscal policy having similar potential downsides to protectionist trade policy.
That's the argument, yeah.
Yeah.
A powerful example of potential unintended consequences.
Okay, let's pivot again. From fiscal policy to monetary policy. On June 10th, the Reserve Bank of India, the RBI, made a notable move.
They did indeed. They delivered a larger than expected cut to their main policy interest rate, the repo rate.
Not much.
Down 50 basis points or 0.5% to 5.50%. And this wasn't out of the blue. It was actually their third rate cut since February 2025. A clear easing trend.
Third cut. And they cut something else too, the CRR.
Yes, the cash reserve ratio. Cut that by 100 basis points, a full percentage point, down to 3%.
So quite aggressive easing. Why were they doing this?
The main reason was inflation was cooling off significantly in India. Headline CPI had dropped to 3.2% in April, which was apparently its lowest in about 6 years.
Okay.
Food inflation, a big component there, had also fallen for 6 straight months. So with inflation seemingly under control, well within their target band,
they had room to act.
Exactly. They felt they had the space to shift focus, try to stimulate growth, accelerate growth momentum, as they put it.
And what was interesting was the context they mentioned.
Yes. The RBI statement, according to the sources, explicitly mentioned benefiting from cooling inflation, but also with U.S. President Donald Trump's tariff threats adding to global uncertainty.
So they linked their domestic move to global trade fears.
Directly. It shows they weren't just looking inward. They were actively using domestic monetary policy as a potential buffer against those external global shocks we've discussed, trying to counteract potential slowdowns from trade friction with some domestic stimulus.
Makes sense. How is this expected to impact the Indian economy, people on the ground?
Well, for borrowers, it's generally good news. Lower rates should mean Lower monthly payments, EMIs on home loans, car loans, personal loans.
Frees up cash for people.
Right. Improves household liquidity, hopefully encourages more borrowing and spending, maybe investment too. The flip side, of course, is savers.
Lower returns on deposits.
Exactly. That's the trade-off. The overall goal is boosting demand, though some analysts were apparently cautious, thinking the initial boost might be more consumption-led than investment-led.
Does a big cut like that carry risks?
It can, yes. And this raises an important question. Stimulating growth is one thing, but analysts cited in the sources worried that such a large cut could put pressure on the currency.
On the rupee? How?
Yeah, pressure on currency, forward premiums, potentially making the rupee vulnerable to, well, depreciation, falling against other currencies.
And what's the downside of a weaker rupee?
Well, it makes imports more expensive. If India imports essential things like oil, that could actually push inflation back up again later.
Undermining the whole reason they cut rates.
Potentially, yes. It can also make it less attractive for foreign investors if their returns shrink when converted back to dollars. It's that classic emerging market balancing act.
Growth versus stability.
Right. Support domestic growth, but maintain external stability, keep the currency attractive. India's move really contrasted with maybe more cautious stances elsewhere, highlighting how global monetary policy is kind of fragmented right now.
Okay, let's wrap this up by looking at how individual companies were dealing with all this. Juneteenth seemed like a real mixed bag.
It absolutely was. You saw direct evidence of those macro headwinds hitting some businesses hard. Core and Main, for example.
Heat infrastructure provider.
Yeah. They missed profit forecasts, gave a pretty flat outlook for the year, and their reasons. Straight out of the macro playbook. Tariffs, higher interest rates, and affordability concerns.
Another direct link from policy to performance.
Exactly. Mirrors the World Bank's points, the designer brand's story.
But innovation keeps going, right? That CNBC Disruptor 50 list came out that day, too.
Absolutely. Even in tough times, companies solving big problems or enabling new tech can thrive. VIAST Data was on that list.
So AI infrastructure.
Yeah, their AI operating system. Apparently seeing hypergrowth, like almost 5x year over year in Q1, and cash flow positive for years.
Impressive. Anyone else?
Ramp was number 6 on the list. Their platform helps companies manage finances, payments, cards, expenses, saving clients money and time.
So efficiency and cutting-edge tech are still finding paths to growth.
Seems so.
What about that trend of companies putting Bitcoin on their balance sheets? That seemed to be continuing?
Definitely. Gaining momentum, it seems. Strategy, formerly MicroStrategy, they bought more.
How much more?
Another 1,045 Bitcoin for about $110 million on June 9th, bringing their total hoard to 582,000 BTC.
That's a lot of Bitcoin.
It is. Cost basis around $40.79 billion. And the sources noted their stock has massively outperformed Bitcoin itself and even NVIDIA over the last 5 years.
Which proponents would point to as validation?
Right, and they weren't the only ones. KLR Technology Group.
They adopted Bitcoin as their main reserve asset before.
Yeah, late 2024. Now they're planning a stock offering to raise up to $300 million, specifically to buy more Bitcoin for their treasury.
Raising money to buy Bitcoin, that's a statement.
It is. And what's fascinating is how the sources frame this, not just speculation, but a corporate Bitcoin treasury movement, a new category of institutional demand.
Providing structural support.
That's the argument, seeing it as digital gold for corporate balance sheets, a potential hedge, a superior alternative to traditional cash holdings, maybe losing value to inflation.
So it's becoming a more accepted, maybe strategic corporate finance move for some, despite the volatility risks analysts always mention.
It certainly seems to be heading that way for some companies. It shows adaptation. The sources also mentioned other things, like UBS focusing on resilient retailers, Costco, O'Reilly, Walmart, the Cow W stocks.
Right, in uncertain times.
And growth in financial centers like Abu Dhabi, Qatar's Islamic finance sector. Lots happening.
So let's try and tie this all together then. Looking back at Juneteenth through these sources.
Well, you see the clear connections, right? The World Bank downgrade is tied directly to those trade tensions.
Which then directly impact companies like designer brands pulling forecasts, Core and Main citing tariffs.
Exactly. Then you have proposed domestic fiscal policy, like the U.S. tax bill and that Section 8 and 99, adding another layer of global investment uncertainty, potentially worsening the trade friction effects. Then you see central banks, like India's RBI, trying to use their domestic tools, monetary policy, to create a buffer against these external shocks.
While companies adapt in different ways.
Right. Some struggle, Some innovate in AI or fintech like VST or RAMP, and some explore totally new balance sheet strategies, like the corporate Bitcoin movement.
It really paints a picture of a deeply interconnected and maybe increasingly fragmented global financial system. The key uncertainties from that day seem pretty clear.
Yeah, the outcome of U.S.-China talks, the final shape of that U.S. tax bill, especially Section 899, the path of global inflation and rates, and just how companies will keep adapting.
And so for you, the listener, trying to navigate this, what are the takeaways?
Well, the sources seem to point towards things like resilience, diversification in investments, and business strategy, paying really close attention to major policy shifts, both trade and fiscal.
Because they clearly have direct impacts.
Absolutely. And keeping an eye on how technology and these evolving asset classes like corporate Bitcoin treasuries are changing the game.
Okay. This deep dive into the sources for June 10th, 2025, it really highlights the challenges, the policy responses, the areas of innovation, a complex snapshot.
It really is.
Yeah.
And it leaves us with a big question, I think, for you to consider. In a world where a trade policy decision in one capital can make a company halfway around the globe pull its forecasts, and where central banks explicitly cite global political threats when setting domestic interest rates, how much can any single country's policy truly shield its economy from that external friction?
And what does that deep interconnectedness mean for how we should all be thinking about investing, about business planning going forward?
Exactly, something to mull over.
Definitely something to think about. That's it for this deep dive. We hope exploring these sources together was insightful and helps you understand the complex financial landscape on this particular day.